So kind of getting into kind of funding, what to look for, how we approach it from a lending perspective, and also just my own experience as an investor, having funded deals through a couple different options. What I would say is, in terms of capitalizing your deals for success, a couple different buckets that I would really look at. Time can mean two different things. It can mean a timeline for your project, but it could also mean how much time are you willing to put into the project itself? How much time are you willing to allocate either to finding a deal, to dedicating to the whole entire process, getting a loan, funding it, working through the project, etc. I think all of that does have a price to it. And I think what a lot of people underestimate is what that time looks like, both from a project perspective, but also from, oh, wow, I didn't realize I was going to be spending so much time, in the weeds or focusing on this. I think from a timeline perspective, that's the one thing that I see, oh, I'm going to be in and out of this project within 6 months, right? That's a very common thought. That's a very common conversation I have with a lot of borrowers. You guys might be surprised at how many people actually will have to extend their term because of unforeseen circumstances, right? I had to fire my contractor. I had to, we couldn't get supplies. There was a delay in supplies, or the house sat on the market for, 2-3 months longer than, we originally planned. There's a lot of unforeseen circumstances that can go into that time frame. So I would say just really making sure that you're comfortable with, if we're going to, as a lender, right, let's say we extend you a 12-month loan, that's more in line with what a common term is from really any lender. Really make sure that you have a good understanding of what that means if you need to utilize the full 12. I feel like there's a lot of people out there who don't really understand that it's extended to you for 12 months. Obviously, everyone would love to get out of the loan beforehand. You don't want to be paying more interest than you need to on a monthly basis, but a lot of people don't plan for that. So I think time frame is one thing that I would say is extremely important, when we look at that. The next bucket would be liquidity, right? And those kind of go hand in hand a little bit, but just knowing like how much liquidity, and we're going to kind of get more into this as we talk about like funding options from that perspective, but liquidity from the standpoint of really understanding like how much money you have solely dedicated to this deal, right? Let's say the cash to close is going to be 40 grand and you have 45,000. Are you running up against, do you have money to get the project started? Do you have money to pay your contractor for the first 2 weeks, right? Like as a hard money lender, we work out of draws. So we work out a draw schedule. So you do the work, we come and inspect it and we approve and we will send you those draws. So a lot of people kind of skip past that part as well. They think, oh, I have 45K in my account. It's $40,000 to close. I'm good. But really understanding that you need to start the project as well. So from that perspective, that's a conversation that I have quite often, as well, is making sure that you're comfortable with what you have and that you're not cutting yourself too thin, in that regard, and doing what's best for you. And then experience, right? I think experience is a lot of the conversations I see first-time investors, sometimes they'll really try to bite off more than they can chew, right? They'll go after, whether it's a multi-unit, whether it's $1 million project, right? Stuff like that. I think knowing what you're comfortable with or comfortable starting out with is important as well. And I think knowing that, hey, I'm going to, either work my way up, and as I get experience, I'm going to feel more comfortable doing these deals, right? You don't want to bite off more than you can chew. I do have that conversation a lot as well. With borrowers who, it's their first time, they have X amount of money and they're looking to really hit a home run on their first deal. And oftentimes I see that as not the best approach, right? I think knowing, what you're able to handle at what stage you're at is actually being self-aware of that is really valuable. And again, that's not to discourage anyone from saying, don't go ahead and pursue a deal. It's your first deal and it makes a lot of sense and you're able to do it. I'm not trying to discourage anyone, but just really getting more comfortable with, again, you don't want to bite off more than you can chew. That's the easiest way to simplify that. It's just a conversation I have a lot. And then exit strategy. I am a huge proponent of this. I've gotten caught in this trap a lot before. Are you going to list the house? Are you going to sell it? Or are you going to keep it and hold it as a rental, right? And I think that we've seen it's been up and down in the past 24 months specifically, as opposed to, hey, what's the Fed's going to do with the interest rates? Are they going to be up? Are they going to stay down? What are they going to do? And just really having that exit strategy beforehand can really prepare you for underwriting the deal better on your side, right? With your numbers. If you're going to sell the property, then you need to know exactly, hey, or maybe you're going to have higher quality finishes to it. And that does make a difference on the lending side from an appraisal standpoint. And something that we see a lot of times on our side is that if you're going to sell the property, you want to make that more appealing to buyers. We're going to put in granite countertops instead of, like, let's say Formica, right? That you might put in, to a rental. Really knowing that strategy ahead of time can save you the headache along the way of having to maybe backtrack on some of the work that you've done and having to pivot. And then I also think it's important to know that aside is that from an exit strategy, like, hey, we're planning on selling this, but worst case scenario is that we can use this as a rental. I also see a lot of people, and I think it's a smart strategy to have, is two strategies in place when it comes to what you're looking to do. I invest that way as well. If we can't sell this, we're going to rent it and it will make sense from a cash flow perspective, or I'll be able to get out of the current loan that I have. That is a conversation that I try to share a lot with borrowers as well, especially if they're on the newer side, only because you don't want to be stuck with a $600,000 property and you can only rent it out for $2,000 a month. That's going to completely eat into your cost and your holding costs as you continue. If the property does not sell, you're just going to be paying that on a monthly basis, which is, as a lender, that's not our goal to make you do. Contrary to what people believe, we do not want to get you to pay more interest in the life of the loan. We would prefer if you were in and out within 1 to 2 months. That's better for you. It's better for us. So that's really what I try to look out for too. So I think having an exit strategy is extremely important, and sticking with that, and then pivoting need be, but preparing, and having a plan if you do need to pivot. So there's really 4 main buckets when we talk about sort of funding options, right? We talk about cash, we talk about a bank, we talk about private money, we talk about hard money, right? I am not biased towards private money because I work in the field. I think that there's a place and a time for all 4 of them. It really just depends on what you're looking for and your strategy. So from a cash perspective, right, you hear a lot about, oh, this one has a cash offer. This is really for high liquidity, individuals who are planning on they may not do as much volume, because buying a property in cash really does take up a lot of that availability that you have. The well does run dry, but it's also going to save you, the holding costs. You're not going to have to pay an origination fee. You're not going to have to pay the monthly interest payments, right? So it's really for individuals, high liquidity, maybe they do low volume, and they're trying to maximize their gross profitability, right? So, hey, I'm going to save myself on the holding costs. I'm going to save myself on the origination fee. I'm going to buy this in cash. We're going to put our own money into it. We're going to sell it, rinse and repeat type of thing. They're not really looking for the leverage that a lender has to offer them. They're looking to do it with their own cash and save money and drive up their gross profits. A bank, who's it best for, right? This strategy, I bought my first investment property through a bank. I did not know better. I did not know really too much about hard money. I did a conventional loan. I did the rehab out of pocket. It was just barely qualified because it was in pretty bad shape, just barely qualified for a conventional. Would have done the whole process all over again if I could have, right? But, there are still situations where banks are useful. Really, we see that from like a turnkey rental perspective. Banks can offer you a lower rate than, let's say, maybe a private money lender would or hard money lender would from like a bridge perspective. Hey, here's a bridge loan, 12-month bridge loan. The property doesn't need any money. We're not going to fund the rehab. Here's 75% of the purchase price we'll fund, and there you go. Banks can typically offer you better terms in those types of situations. So that's where we really see, and I would advise on too, when I have these conversations, it's like, hey, here's a term sheet. We can do this, but I do think that you'll get better terms elsewhere. These, turnkey situations, are specifically, the conversations I have those against. So I think, maybe a local bank, having a relationship with a local bank would be valuable, in this type of situation. Underwriting guidelines tend to be a little bit stricter with banks as well. So that's where a bridge loan can be, a little bit more beneficial on our end. But again, you're going to have to pay to kind of offset that. And in terms of, the return tends to be an in-between, right? You can get a solid profit out of it. You're going to probably pay a lesser, if you're looking for a turnkey, you're going to pay a lesser, capital cost, going to be paying a lower interest rate, getting it through a bank as opposed to, a hard money or a private money lender. Next up, we have hard money. Hard money, I will say generalized, is probably the most popular out of all the examples, and I'll explain why. It's really for investors of all experience, whether you're new starting out, whether you've done 10, 20, 30 properties in recent years. It's investors of all experience, liquidity, credit to an extent. A lot of lenders do have a minimum. We do have a minimum on our side of 640, right? So I don't want to make it seem like hard money, anyone can go and get it. And again, this is part of the reason for, the call today, to educate on that. But hard money really is more of a across the kind of table as opposed to the other 3, which I feel like are more specific situations. The thing with hard money, and again, a negative connotation that comes out of hard money is, oh, you're gonna we're gonna close a loan. It's gonna be a 14 to 15% interest rate. And then if we default on the property, it becomes yours, right? Like there's a lot of things that, we as a lender don't want to see that, right? It's bad for us. We don't want it on our books. We want you to be successful. We want you to do the project. We want you in and out as quickly as possible. And we want you to be able to repeat that and repeat that and repeat that, right? So I think for the challenges of hard money, more expensive closing costs, right? You're gonna have the origination fee, right? You're gonna have an appraisal fee, right? You're gonna have all those costs associated with it. But in terms of mitigating those challenges and what comes with that, I think as long as you prepare for that, right? And again, this all comes in conversation with the lender that you're working with, right? Really get a good understanding of what that term sheet looks like. Hey, this is your term. It's a 12-month term. Your monthly payment is this. This is your closing cost. This is a breakdown of everything. As long as you understand that and you're comfortable going into that, that's where hard money becomes easier to understand. And I think it's important to have people walk you through that, right? And I said to every borrower that I speak with, whether they close with us or whether they're just looking for a quote, whatever the situation might be, as long as they're comfortable understanding the terms and knowing what they're into, then I've done my job, right? I've made them comfortable. The last thing I want is for someone to go into a deal, feel like they need to close, they're under contract, they're scurrying around for funding options, they're strapped too thin, they come to us, we can do the deal, is it best for them, is it best for us? That's a situation you don't want to find yourself in, where you feel like you don't really fully understand what you're committing to. So I would say just get comfortable with the terms, right? Just understand what all of those will look like, and it becomes a little bit less scary to kind of take in. And then another thing with hard money, and I mentioned this before, in terms of cash, you're really optimizing, your own cash. You're not really looking for leverage. Hard money, you're looking for leverage, right? You hear this term all the time, OPM, other people's money. This is what people mean when they reference that. They mean private money, they mean hard money. It's just anything that you can use to leverage against, right? So you're leveraging your cash on cash, you're optimizing that by leveraging our money to help fund the deal. So again, hard money, just understand what you're getting into, understand the terms, and be comfortable with that. But it really does go for investors new to experienced investors, and really anyone in between. And then the last one, private money. Private money is, I think, is a great option if you have it. The problem is it's really a lot of times only offered to expert investors with a proven track record. The joke around, oh, do you have a private, like, oh yeah, my rich uncle is my private lender, right? However, that might be. Oftentimes it could be a family member, it could be a close friend, it could be a close contact that but a lot of times private money lenders will only work with a referral, right? Like, hey, I've done a deal with Greg. He's my private money lender. I'm going to refer my friend Matt to him. Matt is a experienced investor with a proven track record. He's going to be able to, I'll make the introduction, and I know that Matt's going to be a solid, borrower. A lot of times they look for references. A lot of times, they'll do, and they really do tend to pick deals apart, and they're picky about, what they can and won't fund. And that's why I say, finding the right capital partners, because they just seem to be few and far between, right? But I do think that if you can get a solid private money lender and you can build a relationship with them, they tend to be, and I say this working for a hard money lender, they tend to be great partners for you. And there are times where I have conversations with borrowers. They'll come to me. They say, hey, I have a private money guy. He's great, blah, blah, but I'm always looking for better terms. If you have a great relationship with a lender, I oftentimes say stick with that lender, right? Unless the terms that we can offer are so much better, which oftentimes they are not. I always say stick with them, let them, continue that relationship, nurture that relationship. That is always the best way to approach it. And I have that conversation a lot as it comes to, comparing us with private money lenders. So again, if you can find one, that's phenomenal. I think that there is a huge, place for them in lending. But again, the tricky part is a lot of times, they're really for expert investors with a proven track record, as that's what they want to see, to feel comfortable lending you their own money, to do the deal. And then this is just a small breakdown, just from like a return aspect, kind of wrapping everything that I just compared between the 4 buckets together. You can kind of see here, cash, you're not looking for any leverage. That's going to be at 0%, right? Monthly payment, 0, rate fee, 0, holding cost, 0, right? Your gross profit's going to be higher when it comes to cash. And then it starts to trickle down a little bit more as you go down the line, right? From a bank, depending on those rates, depending on, the origination fees, so forth and so on. So again, it's all, if you have the options, to utilize all of them, it's all about what makes the most sense for you and your strategy and what kind of investor, you are, and what you're looking to do, right? And And that's a lot of the conversations I have, is comparing those options, never boxing anyone saying, oh, you have to go with us, you have to do this. What are you looking to do? What's best for you? And what makes the most sense for what you're trying to accomplish? Those are, the questions I ask, and the questions that you need to ask yourself as well.
Thanks for listening to the Deal Machine Real Estate Investing Podcast. Please leave us a review and follow along wherever you're listening to your podcast.